Good afternoon. I'm Vince Lancy, and the Founders Group is joined today by Michael Oliver, a technical analysis guru extraordinaire, although he wouldn't say that, but I will say it for him. I'd like to say thank you for coming, Michael, and we have some questions for you, and we have some subscribers in our group to your stuff. So let's start from the beginning. Most everyone here knows you by name and reputation, but I suspect when this goes out next week, there will be people not so familiar with your work. So by introduction, then Michael can take it. For those unfamiliar, Michael Oliver is the owner and operator of Momentum Structural Analysis. Now, MSA provides unique technical research to the financial industry, both institutions as well as individual investors. The research covers all four major exchange-traded asset categories: stocks, commodities, debt, and foreign exchange. Michael, thank you for coming. How are you doing?
Good to be here.
Thanks. Surfing your site in anticipation of this, and I noted your career path with interest. First, you and I started at the same firms, wildly different cultures, but under the same roof, the same firms nonetheless, on Wall Street. But more specifically, my interest was in how your work and success there afforded you an opportunity to focus on developing your firm, Momentum Structural, the company, as well as the framework. Would you mind sharing a little bit of that?
Yeah, in April '75, I was hired by E.F. Hutton in New York, their headquarters of their commodity division. The guy who ran the department was David Johnston. He was also chairman of the COMEX at that time. In fact, he was chairman during most of that period from the mid-'70s to the early '80s when, the bunker hunt era, okay? The silver was a big deal. I didn't know a darn thing about technical analysis. My background was political philosophy. I was going to be a political philosophy professor, and I said, nope, global stagflation. They don't hire libertarians anyway, so I didn't do it. And a friend of mine had joined Merrill Lynch, and he said, come on in, the water's fine, okay? So I was hired by Hutton, and I apprenticed under the chairman of COMEX, David Johnston, head of Hutton. And he was just a rudimentary technician, bar charts. In fact, back then you plotted your charts by hand, okay?
Right.
1970s, okay? And so I learned basic technical analysis from him, how to draw trend lines, how to plot the bars, all that stuff. And I evolved beyond that, okay? Later, I left Hutton and the headquarters in '76 and went out into the field offices and became a futures broker as such. And so I handled customer clients up through 1992, and then I started MSA. Why did I start MSA? In the '80s, I started plotting momentum by hand, meaning rather than just a simple price chart with some moving average overlaid, which any idiot can see on his quote screen, I oscillated price in relation to given moving averages, meaning the moving average is a zero line, and you plot whether the bar is above it or below it, and you create an oscillator rather than simple price chart. And that creates a different visual picture of what that market is doing than what you see on price quite often. Sometimes momentum and price will be in agreement, but at tops and bottoms, quite often they're in disagreement. And so price is still beating its chest at a high, and momentum saying, you're broken, okay? And you could do it on different time scales. If you're a short-term trader, you could do it on a daily basis. But I was looking at long-term stuff. So I was plotting monthly bars of the S&P 500. And back in '87, of course, we had this great big up move and peaked in summer of '87, August, September, rolled back over. And by the time you opened October, you broke nothing on price, but you broke a very clear floor that had developed on a quarterly momentum oscillator, where I plot each bar in relation, pardon me for boring, each bar.
No, we're here for this.
In relation to a 3-quarter moving average. That's an average that doesn't change its gear position once every quarter. So it's not like a 200-day that shifts every day. So it goes clunk, clunk, clunk. But anyway, there was a structure on the momentum chart that was a floor that had been repeatedly used for 2 years. So this market would drop down to that average and turn up, drop down, and at a certain level on the oscillator. It broke it in the first week of October, and by the second week, we'd crashed. Okay.
Right.
And so I got a smack in the face saying, hey, this is pretty good. I caught it.
Right.
I didn't catch it big time. All my customers and I had put positions. And I took them off, frankly, a little too early. I took them off Monday morning of the crash day. And if I just sat around for the rest of the day, I'd have made a lot more. but,
Right.
but
Right.
anyway,
Who doesn't though? Who doesn't do that?
I know. But anyway, it did teach me that, hey, this tool is good. Okay, so I really went to work on it. I developed it on different time scales. I developed different aspects of the tool. And so I call it momentum structure. In 1992, Wachovia Bank heard about my work. And they're headquartered in North Carolina at the time. And that's where I was too. And they asked for me to provide soft dollar research. I don't know what soft dollar was then, but what it is when they generate commissions in executing trades in their trust department, so forth, they could pay a certain amount of those commissions to research, outside research. It's legal, it was approved by the government. Okay. So I became a soft dollar seller of my research.
Right.
And it was only institutional clients I had up through 2014. And then I opened it up to retail subscribers. And we look at all four major asset categories, like you said, and especially in this day and age, right now, it is very important to look at those because you can't just look at gold and say, whoa, gold did this, gold did baloney. You've got to look at the context of what's going on with these other major tectonic plates, the stock market, the bond markets, foreign exchange, et cetera, because they're having and will have far more impact on one another, especially in this coming year, than most people are ready for. But when we apply our technicals, our long-term momentum trend technicals, we see a stock market that is highly likely at a top. The index we're most focused on right now is the NASDAQ 100. The S&P has already broken its shin bone as far as we're concerned, using our technicals. You look at a price chart and say, well, no, it's just congesting, but momentum says, no, you broke it. That chart there is just a price chart, by the way. That doesn't show momentum. But
Right.
the situation in gold has been positive since our metrics on annual momentum since February of 2016, when it came up from 1,050 low, got up to 1,140. And at that point, this is a daily oscillator of something. Anyway, I think a NASDAQ or something. No, this is probably gold.
Probably gold.
Yeah. But anyway,
I just wanted to put some. Actually, this is probably a better chart to put up to just show a picture of momentum at work, right?
that's an oscillator of don't know what. I guess that's a GDX. I'm not sure. Yeah, that would probably be GDX because you could see that it oscillated about the highs would get about 5 to 7 points over the zero line, meaning
Right.
price would each of these monthly bars would get up to about 5, 6, 7 points above its 3-month average. And then when it closed, it would drop down to about 5, 6 points below. And then when it was a range, and you can see there, this is February of 25. I'm not sure what this is. This may not be GDX then.
Yeah, I tried to get cute and cut off things so I didn't give away too much proprietary
But anyway,
info.
the point is
I cut off everything.
Momentum develops structures. And when you look at a price chart, you're looking for structures. In which people draw trend lines, they draw floors, they draw ceilings, and you get breakouts, quote unquote. Well, momentum will generate those structures, but quite often it'll generate them well before you ever see it on a price chart. And so momentum will tend to break out before price. This would happen in February 16. Gold was coming up 90 bucks off its bear low. And since then, we've never altered our long-term annual momentum trend of gold. It's still positive, despite all the pauses, the couple $100 pullbacks here and there. Nothing has changed to alter that view. And right now, we think that probably this year, especially when the bubble of the stock market breaks, and we think it is the biggest bubble in U.S. stock market history by any metric, time duration, multiple gains, reasons why it occurred. Look at an M2 chart, you'll see. Look at a Fed funds chart, you'll see. We were drug infused since 2009, free money,
Right.
10 of those 15 years, money was free, Fed funds.
Right.
Even when they raised rates, a year ago, and got up to 5+%, that was still historically dirt cheap for Fed funds rate going back 50 years. I mean, it's still free
Right.
effectively. And
Well,
so,
we had that 10 years ago. I remember in
yeah,
'09 when they raised rates.
sure.
Yeah, yeah,
Yeah,
yeah.
and so it didn't stop the stock market. It's still infused with free money. Well, anytime you make a decision, whether it's an investor, a company buying property to build a new factory, hiring new workers, state government going to build new highways, federal government spending, all these are based on variables. One of the big variables is what is the cost of money? And if you're taught falsely by the central bank here and elsewhere that money is effectively free, or certainly freer than it would otherwise be if it were market priced, you make a decision based on that assumption, but it's a false assumption. It's
Right.
unreality. And so we've had unreality in effect, monetarily speaking, since the Fed went berserk in 2009 onward. And again, after the COVID event, they went berserk again. But there's a point at which the berserkness ends. And even the bubbles that we had, like 2000, the dot-com bubble, okay,
Right.
that was a period also of this type of monetary process. Nothing compared to what we've had, okay. So even
Right.
the bull market was only a handful of years. It was a doubling or tripling of the indexes.
Just to throw this in there, for
Yeah,
those of you young, in 99 to 2000, it was raising rates that stopped the market, and then they eased rates, and then it collapsed
yeah,
the
it
housing
collapsed.
market.
Yeah, yeah, yeah.
Right. Right.
There was, and they cut rates in, I think it was May. No, excuse me. They quit raising rates in May of 2000,
Right.
right in the middle of the topping action.
Right.
And in
Right.
January of 2001, they cut rates twice. We were
Right.
only marginally off the high at that point.
It's amazing because in '08 the same thing happened. In
Yeah.
'08 we
Oh
raised.
seven, they cut rates in October, in September
I'm
of
sorry.
07.
I'm sorry.
Yeah,
So it's
yeah,
'07, in September 18th of '07, which is when we started cutting rates again here.
yeah.
September 18th, they cut 50 basis points. We made a new all-time high, and then it was a crash after that. So
Yeah.
I'm looking at the parallel saying it's kind of interesting how when we start cutting rates after a rate hike regime, that's when the market kind of craps out.
Yeah,
Anyway,
and it doesn't work anymore, cutting rates.
that's right.
Doesn't save the assets they want to save because reality takes over and those assets are bloated too much. And so even the reality of the internet bubble, which was that it'll change your life. Well, it did far more than we expected
Right.
positively. And yet the NASDAQ 100 dropped 82% in that 2-year period.
Right.
So, it got overpriced and even Fed rate cuts couldn't save it. I think we're at the same position now, but when those bubbles break, that money goes somewhere. And you go back and examine each top in the S&P, or look at even the Dow in 29 through 32, where there was no gold in, it was illegal. Okay. But
Right.
if you bought Homestake Mine, it went up 1,000% in those years. The biggest gold miner around. And you go back to the 19 mid 73, 72 top, and the stock market collapsed to 74. All during that time, gold was going up.
Right.
2000 to 2002, gold bottomed and started its advance. 2007 to 2011, stock market topped, went down through 2009, and gold went up all the way through 2011. It was an alternative. It's
Are you
happening. It's happening now.
a quick question about like you've asked one of the other questions I want to ask about momentum, but specifically about stocks because I'm interested in that right now as well, right? Um, um, do you see a momentum structure that's breaking or that has broken? Where are you in that momentum picture right now?
Now, when we look at long-term trend metrics, that would be like measuring price versus its 3-year average. I don't care where the average is, whether you get below it or not. That doesn't matter that much sometimes. It's the structure on momentum. And that structure shifted into a positive zigzag back
Right.
in early 2016. And
Right.
it has remained in a positive zigzag trend situation since. With that sell-off, remember in 2022 when gold dropped from over 2,000 down towards 1,600, even that was not enough to convince us that it's over. We said, this is a bear trap. Because why?
Right.
Annual momentum said, you're not breaking, you're going down to support again. And the price
Right.
chart looked like hell. But we said it's a bear trap. Boom, within months, you're back to the high.
Right.
And
That was during the rate hike regime. Putin invades Ukraine, the Fed starts to raise rates
Yeah,
in March
yeah.
or April, and then everything goes to zero and then just
Well,
bottoms and
even,
reverses.
everybody thinks war causes gold to go up. Baloney. If you
Right.
sold the war event in February, March of 2022, remember the Russians invaded Ukraine
So that
in
was the peak.
late
It peaked
February.
and then
Yeah.
sold
So
off.
2 weeks later, gold commodities peaked
Yep,
and gold had the drop of 15%. Okay, if you
that's
call
right.
that a collapse. And it was back to its highs later, but the war didn't take gold up, it took it down. Okay.
Right. It
So
did.
probably peace now is the reason to buy gold. Okay.
I know I'm
Yeah.
struggling with that right now. I'm like, oh, pizza's going to break out. Maybe
Yeah.
we should buy.
We should buy gold. Just what nobody thinks. Okay.
Don't give me more excuses to be bullish, right, Michael? Don't do
Okay.
that.
But
Uh,
anyway,
I have a
so
question. I have a
yeah.
question about speaking of that, because I know that they want to talk about that if I can. Um, recently, um, the banks have finally jumped on top. They seem to be getting behind the bull market, calling for levels ranging from 3,100 to 3,300 to. I just got a report from Goldman today. I mean, it's bearish ultimately, but they're telling their clients to buy these calls for 3,500 print in December. But all shenanigans aside, please put these price bank targets in the context of your own feeling about the current phase that metals are entering. I know that you're looking at it like 7 or 8 times. These targets are just BS, but I think
Yeah.
people need to hear that.
How many times have they raised them? You know, you go back and look at Goldman Sachs or whoever you're citing, and they probably raised those targets 5 times in the last year. Okay, so it's
Right,
sort of meaningless. And it's
right,
always in 100-point increments. It's never.
right,
You know, they're not seeing the reality, and the reality is this is the biggest asset bubble the U.S., India, and Japan have seen. They're also bubble stock markets. Okay. So when we go, they're going to go too. In fact, we've already got breakage in both the Sensex and the Nikkei.
Oh,
The,
there you go. We
the,
have a guy here who's going to ask you about
Mhm.
the Sensex, the BSC. So I'm with you. Okay,
Yeah,
keep
but
going.
it's
We want to hear
those
this.
markets have been moving with us,
Right,
slightly less percent gain than we've had, but still
right,
massive, massive gains. China, for example, is not a bubble. It's only double the price it was in 2009. S&P
right,
is ninefold. Nasdaq 100 is 18-fold. Okay, so there's no comparison. But India and Japan do have bubble stock market conditions, and they, like the S&P, have already triggered our quarterly momentum sell numbers this past month and January
thank you.
Sensex. Okay,
Right,
we're waiting on the Nasdaq 100. It
right,
got below our
right,
number Friday, and in the last 15 minutes rallied and closed back above it as if it knew. And it's not some round number either. It's some very precise number. So,
right,
but once we break, we're arguing that at that point, the money flow out of that bubble, and not all the money gets burned up, okay? It's
right,
not like it all gets destroyed. The money,
right,
smart money moves it somewhere else. They're already buying T-bonds just recently. T-bonds know something, and it's an asset flow. Gold has already been going up the whole time. I mean, most people don't know this, but I'll give you some numbers to deflate certain notions. Hold on. Last 12 months, February close last year to February close this year. Gold and silver both up either side of 38%. Silver's
right.
matching gold, by the way. Stock market, either side is 16%. Whereas gold and silver up more than double over the last 12 months than what the stock market's doing. Okay. It is? No, okay. This year, January and February, so 2 months of this year, gold and silver up either side of about 7.7% for the
Right.
year. Okay. S&P up 1%, 1.2%. Nasdaq 100 down 0.6%, less than 1%, but they're flat. Gold and silver
Mhm.
up 7, almost 8%. And yet nobody's noticing this. What's going on? It's a money flow. And when you punch a hole in that big bubble and that river starts to flow, it's going to exacerbate what we see in gold and silver.
Right. Right. It's starting to feel, as you're saying it, I'm hearing one of my last questions is about stagflation. I'm hearing the whole, this is the beginning of a leak into stagflation. You know what I mean? So anyway, it could or could not be.
We had that in the late 70s, and look what happened.
I know.
Commodities exploded, gold and silver exploded a lot more.
I know. As you know, as a kid, I remember a conversation with my father. I was in Philadelphia in 1976. I mean, this is like right in the cusp of your career change, right? It's
Yeah,
75 and inflation has backed off and stocks have rallied. We have no money in the stock market, but we run a business. 76 comes and Philadelphia is the cleanest city on earth. And everything, inflation is at zero and the Fed is lowering rates. And my father, I go, this is great. Everything's going to be good now. Your business is going to do. He's like, Vincent, they're just. He didn't say this expression, but he basically was saying, Vincent, they're just painting a turd because of the bicentennial. And when this is over, the inflation comes back, and things will be worse than where they were. And don't you know, 1977 to 1981, that was it. That was the end of the economy. Anyway, so that's my
yeah,
doom.
yeah. And the stocks were a wasteland really from the mid 70s to 1982. I mean, they did this.
Yeah,
But basically you draw a line sideways. It was a dead body. Okay. And gold, went from uh, $30 in 1975 to 200, backed off to 100, and then went to 850 by 1980
right,
from a
right,
low near 100, eightfold
right,
move. It's had two of those, by the way, in the past 50 years, eightfold moves. Well, if we have an eightfold move, given the crisis factors out there that are far worse than they were before, we'd go to $8,000 because our barrel
right.
was 1,050. And so
That's your key chart. I should have
I
that
throw
here.
that out as just a note to people to pay
Yeah,
attention
yeah,
to, they're measuring every $50 move in gold. Stand back and look at it. But when the stock market breaks, that will help exacerbate it for a couple of reasons. The money flow, but
right.
two, you know what the central banks will do then? Place
Well,
any
they'll
bets?
probably print
Okay.
again, right?
Oh, they'll print like crazy. And I don't mean just the Fed. I mean BOJ,
Oh, yeah.
ECB, the whole deal. They're going to go nuts.
We're
And
going to get stimulus checks again, Michael. Remember
huh?
they started that whole stimulus check nonsense?
Yeah, yeah,
We're going to
fine.
get
Yeah,
those again.
good.
That's going to happen.
And gold loves it. It's
Gold
like
loves it. Right,
flowers falling on the parade. It just loves it. So anyway, that's where I think we are. I think we're at the acceleration phase in the monetary metals, where no
right,
longer is it for silver 4 steps up and 2 steps back, and gold 3 steps up, 1 step back. It's no
right,
longer arm wrestling, it's more verticality. And
right,
by the way, I also argued that I don't think when this was over on the upside, that it means a top, that it means a bear market and a crash. We're in a different world now. A lot of
right. So higher plateauing's higher and sideways is what you're saying.
Well, it could be the gold that governments finally wake up and they monetize their currencies, with gold and silver,
Right,
and it no longer is it just fiat, whatever we want to do,
right,
approach, and the world will change. What will cause that? Massive destruction, which breaks certain assumptions, certain institutions that now seem dysfunctional, like a Federal Reserve. They've done good since the past 100 years. Well, they create monetary boom bust, and sure enough, you can lay a stock chart, shift it 1 year to the right, and there's your stock market. Okay,
right.
boom bust cycle. Pretty soon, people will wake up and say, "Hey, this hasn't worked." So a lot of changes are going to occur in this particular global market situation.
Well, that's the fourth turning.
Yes.
That's that's the fourth turning type stuff, I would call it collapse of complexity. Like all these
Yeah.
agencies, to keep it simple, they're just dysfunctional and they're no longer. What's the word? You were in an interview with Alistair McLeod. The expression he used was they're no longer fit for purpose,
Yeah.
and therefore they're
Yeah.
dispensable. The
Yeah.
English way of saying, you're worthless to us.
So,
In your most, look, I know people are going to ask about miners. That'll be like the hard question. But I want to ask about current events in your most, with regards to gold. This again, we're not panicking about the short term here. I just want to hear. I think people would like to hear what it means to you. And again, we're all big picture people here. So, in your most recent report, just to put a little frame on this, about gold, you called the recent pullback a benign correction thus far. Now, can you elaborate on that? Would you care to
yeah.
elaborate on that?
Well, in between 2000, when we surged in gold up to $2,070 price,
That's
That
this
was
chart.
summer of 2020.
Yeah,
Gold went into a maximum 15% range. Most of it was really a 10% range. Up, down, 3 times getting over 2000.
right,
Wouldn't launch. That was still part of the uptrend. It was just a massive pause. In March of 2024, a year ago, almost, we put out a report saying, okay, sideways is over. We're resuming the uptrend, the
right.
lowest period.
Remember
Okay. Gold then was just above 2000. Silver was 25 to 26. Look where it is now. GDX, the gold mining ETF, was 31 and a half. Right now it's around 40. Okay. They surged. But if you examine every pullback in that surge, in our weekend report, we're doing that for our subscribers. We're just making a point. Look at
Right.
every single pullback gold has produced since coming up out of in March of 2024. And there have been multiple pullbacks, 4, 5, 6%. One was 9%. And yet they were all, when they're over, back to the highs.
A lot
Okay.
more V-shaped bottoms. You're right.
Yeah, they
You're
were
right.
like V-shaped bottoms. And yet in every single one of those, by the way, the current drop is 4.3%. Okay.
Right.
Every single one of those was a fake out where everybody out there, you could see it on the internet, the free analysis. It's over. It's going to correct to this level. It's going to go down for 6 months. That's
Right.
the top, et cetera, et cetera. And it wasn't. It rarely ever got to where they thought it would go, and it didn't last long, and it certainly wasn't the top. And now we have another one that's really smaller than most of the other breaks over the last year. And yet they're
Right.
saying, oh, that's it. That's it. No, it's not. It's just another hiccup. And when we run
Right.
short-term momentum, and we show that in our weekend report, like measuring daily action, for example, and
Right.
oscillating it against a 3-day average. So you get an oscillator. The oscillator is in a downtrend, but it's got structure, what we call structure, meaning a clear trend line, such that if you hiccup just a bit, like you get gold back up anywhere near 2,900 in the next several days,
Right.
in the upper 2,800s even, you're going to break out and go back up again. In other words, the
Right.
break is over.
I think that's the chart that I put up there. I think you're talking about that. Do you
I
see?
didn't issue it yet, but what you got there, show the price
No, I
chart.
mean the most recent one. It's
Okay,
a
well, this is yeah, this is as of Thursday, so that doesn't show Friday here, but
right. Doesn't
this
show
is the
Friday's
daily
action.
momentum of well, this would be gold. Yeah, okay.
Yeah.
You could see that it's oscillator highs back in January. Get gold up to 60 to 70 bucks over the zero line. Well, what's the zero line? It's a 3-day moving average, very short-term metric. It's this minor trend. Okay.
Right.
But look, it's developed a downtrend structure. In other words, if this were a price chart, you would draw that line, that green line, and you could see you rally up to it, you fail, and it's descending. And right now, in fact, the line goes a little lower because you're missing Friday here, but
Right.
you get back above the zero line, which is in red. That's a first thumbs up. You get above the green line, it's saying, hey, that's it, guys. That was your
Right.
decline. And in price, that's going to occur looking out to, let's say, Tuesday or Wednesday. If you get gold even back up toward 2,900, right now we're just below 2,950, 2,850. So,
Right.
and silver, we're using the May contract now, you get it up about 1% above where it closed Friday. It was about 30, 40 cents. It's going to break out over a similar structure, meaning momentum says, hey, you had your correction. Now, you look at this momentum chart. It's been descending for over a month. Price only recently broke. Price
Right.
lagged to this decline. And
Right.
it's just the same is going to happen the other way. When momentum breaks out, price will barely be off its low, and it's not even going to realize there's a structure there when you look at
Right.
price chart. But on momentum, you can see a very clear structure. And this,
Let me quote you from the report you put out, I think Thursday, and it's
okay,
about this chart, and it's exactly what you said, but using different terminology. The problem, let's say we want to be bearish here. This is, I think,
yeah,
pretty important what you said here. The problem with being negative here is that daily momentum's cooling off corrective process is now 3 waves to the downside and
mhm,
involves 19, now 20 trading days. Momentum circled in black, um, finally closing below the zero line after holding above it on closes for the prior 13 days.
yeah,
And you'd be ahead today by a few dollars. In sum, this is what MSA terms a benign correction. And if you look at
yeah,
that, from how we look at stuff on GoalFix, not knowing anything about this is a short, not knowing anything about how you calculate. Look at all the time it spends